That's the RBA's decision today, and are we going to get another supersized rate rise? It certainly seems likely. The markets are pricing it in. So let's go to Tim now over at CoreLogic. Tim, good to see you. A lot of talk this morning about all this aggressive tightening of monetary policy and expectations and forecasts, perhaps, that it could crush the housing market. What's your take on that?
Well, clearly, higher interest rates are bad news for housing. It does tend to have a negative impact on housing demand and activity. And it was quite clear from the beginning of May, as we started to see interest rates rising off their emergency lows, that was a very clear inflection point for the housing market. We started to see Sydney and Melbourne housing values falling quite sharply after they were already trending lower. But then Brisbane, Canberra, Hobart really started to show a very sharp decline as well. So chances are with higher interest rates, we'll continue to see housing prices falling. But there is a little bit of evidence just recently through September that the rate of decline in housing prices is just starting to ease off. So maybe this initial shock of 50 basis point hikes already is starting to get priced into the market already. So hopefully we're starting to move through the peak of this downturn.
What if the markets are right, though? We get a supersized rate rise today. Given that there have already been these changes up until this point, what would another supersized rate rise do in terms of the housing market as well as affordability?
Well, I think almost undoubtedly it means housing prices will fall further from here. We're expecting prices will continue to fall until interest rates stabilise. The timing of that is still highly uncertain. Hopefully it's in the first quarter of next year, if not then the first half. But of course, interest rates are coming into the household sector at a time when households are at record levels of indebtedness.
Yeah.
This is one of the reasons why they're so sensitive to a higher cost of debt, and that's being compounded by really high inflation rates as well. So you'd have to expect the impact on the economy more broadly is going to be a pullback in consumption just around the corner.
If we go to a worst case scenario here, and that's this tightening policy has been too aggressive, it ultimately takes Australia into a recession. That means more people may find themselves out of work and an increased likelihood that they won't be able to meet mortgage repayments and may well default on those mortgages. Again, a worst case scenario. But I mean, is that likely? Is that a possibility?
Well, I think the likelihood of Australia moving into a recession is still relatively low, but of course it is increasing as we see interest rates moving to a contractionary setting. I think for most households, they're managing their mortgages quite well at the moment.
Yeah.
To your point, Pete, if we did start to see labour markets loosening up substantially, then that would be the key risk for more households not to be able to meet their mortgage obligations. So hopefully we don't see labour markets loosening too much. I think it's pretty much a given that we will see unemployment rising as the interest rate moves to a contractionary setting. Yeah. But to get back to, say, average levels, that's still a long way off for the unemployment rate.
I guess, and just we're wrapping up here, someone's misfortune can be at another's advantage. Does that mean more housing will be available at a more affordable option in the first quarter of next year?
Well, that's definitely one way to look at it. It's a silver lining that lower housing prices do make housing more accessible. But on the flip side, mortgage serviceability and borrowing capacity have obviously been negatively impacted as well. So clearly borrowers can't borrow as much as what they used to, which really does imply that credit activity or mortgage-related activity may not bounce back quite as quickly as what it might have had interest rates not been this high.
Hey, Tim, just a final one here. Who's doing worse at the moment out of Sydney, Melbourne, Brisbane?
Well, Sydney is leading this downturn by some margin. We've already seen values there fall by 9%. That's wiped roughly about $104,000 off the median value there. Yeah. Brisbane's playing second fiddle of the three major capitals. Housing values are down 4.3% since they peaked, but the monthly rate of decline has now surpassed Melbourne's. So it does look like Brisbane's playing catch up to some extent after values rose by about 42% through the upswing.
Yeah, worth reminding our audience about that, those huge upswings before this current downturn. Tim, appreciate that. Thank you for your time this morning. Tim Lawless there from CoreLogic.